Welcome to the Daily Update. This is being prepared Tuesday, June 7th, where we'll look at the action in the market today and then see how things look for Wednesday, June 8th. And before I get started, number one, I apologize for not being able to post a daily video for Tuesday. When we have significant changes in weather, especially during changes of the seasons, I get some pretty intense sinus headaches that wipe me out completely and pretty much make me useless, even more than usual. Secondly, as I'm recording this video, you will likely hear some background noise. There is construction going on around me that I can't control, and this is the only window of time that I have to record. Going over what happened in the market briefly, we had an up day. It was a pretty slow open. It looked like, well, it's going to be a pretty sleepy day today. Well, things ended up picking up, and we ended up having an up day. And our charts continue to show some improvement. And I have some other things that I'm doing some research on, specifically on the 2-year yield, that we can watch that might give us some insight as to the movement of the S&P 500. Right at the open, we gapped lower, and it looked like, okay, here we go. We're going to have a down day. And it started off down. We gapped down to S1, which was at 40.97. We were able to build a base at that level. Instead of pausing before we got ready to go lower, we actually built that base and then climbed back up to the daily pivot at 41.33. As the day went on, selling entered and then actually took prices negative. And I'm like, okay, here we go. Maybe we're going down for the day. Not to be dismayed, though. Buying took prices back positive and back above the daily pivot. Going into the close, we saw some late day buying, which took us above R1 at 41.57, and we closed almost at the high. So it's kind of the tale of two markets. The morning was pretty negative. We tried to turn more positive, switched back negative, and then got positive as we went into the close. We were up 0.95% on the day. Volume was below average, and that's pretty much what's been happening lately. So it's really hard to read anything into that. On down days and on up days, we are seeing below average volume. The technicals are still fairly negative, but starting to improve and showing the continued improvement that I've been talking about. Of course, inflation and interest rates, which produce growth concerns, that's the focus of the market right now. We have lots of different geopolitical concerns, of course, and that can feed into the scenario at any time, and then earnings as they are released. So what are some comments that we can make? During the night, Australia raised interest rates 0.5%. Well, that would have been fine, but they were expecting them to be raised 0.25%, and that shocked the markets. That kind of bled through into Europe, which then bled through into the US and gave a bit of a negative backdrop to things. Gas prices, that's what you're hearing about all over the news as it continues to spike, and they're trying to have these races to see who can find the highest price, and it's just awful. It's hoped that all of this attention that's being put on gas prices, maybe that'll make it go away, because the news media, they don't have a very long attention span and they want to move on to the next thing. And right now, gas prices are the interesting thing to talk about. Well, let's see if maybe things will calm down and maybe even get more favorable, and that'll take it out of the front end of the news cycle. Oil's up over 119. Yeah. Fear is still high, but not necessarily extreme, and that depends on which gauge you look at. We have one gauge that's showing fear, and that's the one we look at every day. The other gauge is more neutral. The economic reports that came out, we had the trade deficit, which narrowed to $87.1 billion. That's fine, but they expected it to decrease to 89.6. So it actually decreased more than expected. And they're blaming this on supply chain issues, which could be getting better. Consumer credit increased by $38 billion, and that's what we're seeing. We're in difficult economic times, and people are having to use credit just to buy food or gas, and that could really feed into a dangerous situation. The condition of our trend, it's actually positive now, and I'll show you the chart, but it's not trending because we're below 20. As far as our bias, I'm still kind of mixed overall with a positive slant because things are looking a little bit better, where our momentum is more mixed. It's just really hard to make a black or white assessment of the momentum right now. Let's go back and look at the day's session. I have a lot of different charts to show you this time, and something that I'm going to spin off and try to explain briefly. We are at 33 now as far as our fear gauge is concerned. We're still in the fear territory. And here's just the historical chart showing that we were able to get back above 25. This is the other greed and fear index, where they take more components and put them together, or I should say different components. The fear and greed index that we use, I think, uses 7 components. These are other readings as well, and we're just about in the middle. The VIX is continuing to show a decline on a closing basis, and we closed right at the bottom of the bar because we closed right about at the high. The VIX of the VIX continues to show that the VIX itself is becoming less volatile. The bars are going down, as is the closing values. The Ulcer Index has dropped below the moving average, so that's also showing that fear is coming out of the market. We're dropping with our equity put-call ratio on a one-day basis, but we're still kind of high, and we tick down a little bit on our 5-period moving average, but this is still kind of an extreme reading. The RIDEX bear-bull ratio did come out, and it actually dropped. We were all the way up close to 0.21. Now we're dropping down to 0.07. It's still kind of high, but it's pretty much neutral when we get down below 0.04 or 0.03, or even down into the 0.02 range. Here's another sentiment indicator. It just measures stock positions across all different investors and then compares it to what it was a year ago. When we get -1, that shows an extreme reading, and +1 shows an extreme reading. Well, we're down below -1. Looking at this chart, it just shows where we had been pretty much extreme, but we're coming off of that now. They're giving a reading of 1.1 currently. So we're not as fearful now, according to this, as we had. And that kind of lines up with some of the other things that we're seeing as well. Another thing are inflows into bonds. They continue. They're really going up. They really spiked down during the COVID plunge. They really spiked down when China devalued their currency. They really spiked down when we had a taper tantrum back in 2013 or so. It's still showing that people are putting money into bonds. Now, why would they be doing that? Bonds have been doing really terrible. They're still considered to be less risky than stocks. And if stocks really head south, which is what most people think they will, I'm not saying that's what will happen, but that's what the general consensus is, then people are taking their money out of stocks and putting them into bonds. That's more of a risk off, where you might lose less and still get a bit of a return at the same time. Another thing is showing the debit balances and margin accounts on a year-over-year basis. It's really declining. And we've been seeing that in the current market valuation charts. And then this is the S&P on a year-over-year change. And it's just showing as the market's going down, people are using less and less margin because most people go long in the market. They want to buy low and sell high. And when that becomes a real threat, they stop doing that. They have to pay that money back that they've borrowed. And we're starting to get to kind of an extreme reading here. Could that help push prices higher? Another chart just shows leveraged ETF trading. And I use a lot of leveraged ETFs, and I teach about these in my classes, where if you have a regular ETF and the S&P 500 goes up 1%, well, that ETF goes up 1% as well. A leveraged ETF could be, okay, if the S&P goes up 1%, this ETF goes up 2%. And that's really, really nice when you're right, but it also works doubly against you when you're wrong. This is just showing the ratio between leveraged long, we call those juiced ETFs, and short ETF volumes. Those are inverse ETFs that make money when you go down, because there are ETFs that if the S&P goes down 1%, there are ETFs that go up 1, 2, or even 3% in response to that. What this is showing is most people are into the negative or bearish or inverse ETF, and this is giving us a bit of an extreme reading. We can use this as a contrary indicator. Another thing is the S&P, which is on the top, showing how we've been going down, and I pointed this out before, where we're seeing a higher low with the VIX. So that could be somewhat positive. Another thing that I updated is the Economic Policy Uncertainty Index, and that really spiked up. Also, and I pointed this out in the weekly video, that we are seeing inflows into mutual funds and ETFs. It's not very much, and we would like to see this continue to grow, but at least it's positive right now. So that's a bit more of a sentimental positive aspect on things. Looking at inflation, gas, man, my goodness, it's come down, but look at how it's just going parabolic here. Heating oil is also really, it was down, but it's still very, very high. This is what Goldman Sachs is thinking, because on Friday we have the CPI coming out. The scenario that a lot of folks are using is that maybe inflation has peaked and it should start coming down. And they think the core components of that have topped out already and will continue to decline. The PCE, which also may have topped out, and they continue to see this decline as well. Now, this could get all blown out of the water after Friday when we get the report coming out, but this is where they see things right now. Another thing is it's called the evolution of recession and expansion lengths. And over on the right-hand side, this is how long we had a contraction in the economy, and then after that, how long did the expansion last? In the 1800s, they were kind of even. It went a little bit higher in the 1900s up to 1949. It got even higher from 1950 to 1999, and now what we've been seeing since 2000 is shorter contractions and then really longer expansions during that time. This is the Economic Composite Index against the S&P 500. And this just shows how we've been coming down, showing some weaker economic growth. Well, the S&P has been coming down also. I didn't get to do this in Tuesday's video. I did it on the weekly video. We had the update over the weekend of the current market valuation. They're still suggesting that the market is fairly valued. These are live charts back here. The yield curve is still fairly valued. It's more gray right now. The Buffett indicator has become overvalued where it had been fairly valued. The PE ratio is still overvalued, even after it had been extreme. Interest rates and margin debt are still fairly valued, and the mean reversion is still giving us an overvalued reading. So when they take all of these together, they're coming up with a fairly valued to slightly overvalued valuation. Speaking of valuation, this is another thing. Current valuation relative to the long-term average. This is based on forward. Now, a lot of the charts that you see me use are based on TTM, the trailing 12 months. There's also another thing called the forward PE ratio, and that's what the stock market uses to justify its current prices. Right now, the S&P is at 17.3, looking forward at the time this chart was created. The 20-year average has been 15.4. So this would suggest that even though PEs have come down and they're under 20, which is more of a static number that a lot of investors, including myself, use, it's still on a relative basis considered expensive. The equal weight S&P 500, which I don't show as much, but that just treats all stocks within the S&P the same, whereas the S&P 500 is a weighted index, and so the big stocks have more influence on the S&P 500 than the smaller stocks. They are actually considered to be a little bit cheaper now, where the current PE ratio is 15.2, the average has been 16.8. Mid caps are also considered cheaper right now, and small caps are considered cheaper as well. And I talked about this also in the weekly video. We are showing that on a relative basis, small caps are looking inexpensive. And that could help us out. If we see a lot of upward movement in the small caps, that could easily feed over into the S&P 500. And I'll talk more about that later. Looking at our sectors, we had 10 out of the 11 that were up. The only one that was down was discretionary, and it was down only 0.25%. And here is how they've been performing since January 4th, with energy, utilities doing the best. Discretionary, even though it's down a little bit, it has been performing the worst so far. I'm looking at the staples sector itself because we're looking at our staples spike to see if that is still a legitimate signal. Because a lot of times when the staples to S&P 500 ratio, when it spikes and starts going down, that will often mark a bottom in the S&P 500. So I want to keep an eye just on the staples sector by itself. It was up 0.5%, but it wasn't up as much as the S&P. So this means our spike went down a little bit, and I'll show you that when we get to that chart. Technical alerts, not very many. They were negative when the market opened and then turned more positive, where the S&P did go below 4,100 and the NASDAQ went below 12,000. Then it got back above 12,100. The Dow got above 33,000, and we had an NYSE BPI cross above 50. That's a broader market measure. That is also positive. Looking at interest rates, and this is what I've been doing a lot of research on, and I'm not quite sure how to present this because the data that I have doesn't lend itself to what I want to try to point out. I showed this in the weekly video, and I just stared at this for a long time, and I thought there's something in here that could help us. Well, if you look at the yellow line here, this is the 2-year yield rate, and it dances around. The blue line is the Fed funds rate, and you see how they tend to move in conjunction with each other. Well, the problem comes is when the bond market or the 2-year yields, they get ahead of the Fed. And something needs to change. Either interest rates have to come down, which could help stocks go up, or the Fed has to raise interest rates faster. It means they're behind the curve at this point. That's what happened in 1994. And I really tried to be able to put an S&P 500 chart on top of this, and it's not as easy as it sounds. Mainly because the blue line here, which is the Fed funds rate, the last price I have for that was April 29th. It doesn't update every day. So I'm trying to use Eurodollar futures that they go more hand in hand with the Fed funds rate. And I'm trying to work some ways that I can present that to you. So bear with me on this. But we're looking for times when they really get out of line with each other, and that usually means something big happens. And we had, just trust me on this, I guess, after we had this real spike up, it had gotten far away from the Fed funds rate, we saw a really nice run up in the market after that. Back in the late 90s, early 2000, we saw where they just went hand in hand. Later on, from the 2005 to 2009 period, it was also really good back in 2015 to 2019. Well, now we're seeing things way out of line. This is the 2-year yield. And that's why, even though I made a short video yesterday, I said, watch the 2-year yield. If it starts going down and the S&P is going up, that could really help give us some power. Well, interest rates did go up yesterday with the S&P, so it doesn't mean that they can't both go up or both go down. We want to look at how are things behaving over a period of time. One thing that I'm looking at here is we have the Fed funds rate. This does update every day, and this is compared to the 2-year yield. And this also is just showing pretty much what we saw back here. The red line is the 2-year yield. The blue line is the Fed funds rate, and it just shows how they're really far apart from each other, where most of the time they tend to go hand in hand. This just means the Fed they should have been raising interest rates already by now, but they haven't. Here's another chart that I've been working with. Here we do have the S&P, and we have the 2-year yield with the red dots. Just shows how it's been going up. And then we have a correlation between the S&P and the 2-year yield. And when this gets pretty low, that sometimes tells us things. And especially when this thing gets pretty high. When it's +1, that means they're going in the same direction. When it's down here, that means they're going in the opposite direction. Just as an example, We had that really nice run up in March. Okay, well, right about that time, this line had been starting to go up, and we went up and up and up, and then this thing fizzled out. Well, look at where we got to with the correlation reading. We pretty much topped out at this point. Everything fizzled out. This is when a lot of people got in thinking, okay, we really are for real, and then things just went down after that. As we started going down, we saw the correlation going down as well. It also went down here. We saw a little bit of a bounce, and then we've been just gyrating all over. Okay, so right about the time, not too long after that, when we're potentially bottoming out right here in the S&P, not long after that, we saw a pretty, not real extreme reading, but a negative reading nonetheless. And what we're watching for is to see if the S&P goes up, what's the correlation between that and the 2-year yield? Because the Fed is behind the curve, and we know we have 2 more rate hikes at 50 basis points each, so we have another % in interest rates we still have to go. We're also seeing, and I have a chart to show you this, we're seeing PE ratios coming down. What was happening back in March is as this was going up and the market was going up, that was raising the PE ratios, getting the market back to a more expensive stance. What we're watching for now is we've seen PE ratios coming down, and as the S&P goes up, yeah, this can go up, but as long as it doesn't get too far extreme, that might give the S&P more room to go up. All right, and then this is taken from Yardeni's morning update, where it just shows from 2020 through 2021 how, and this is the forward PE ratio, and that's what the market uses. Just shows how we've really been coming down. Now, on a historical basis or a 20-year average, we are still expensive, but this is a lot lower than what it had been. And this just shows where it was as of last Friday. So we want to keep an eye on this. If the S&P goes up, is this line going to go up too, meaning the market's getting more expensive? Is the 2-year yield going to be going up or down at the same time? Hopefully, looking at all of them together will help us understand if the S&P does go up, is it going to get some legs behind it? Another thing is the probability of a 50 basis point hike in September. Right now, they're saying it's at 66.8. I go to the Fed Watch Tool website, but I saw this at IsabelNet and just thought, okay, I'll just throw it up here. Another thing are 10-year yields. This is what Goldman Sachs is predicting, that we're probably going to top out at about 3.3 still in 2022. Then we're going to drop down to 3.15 and into 2024 stay at about those levels. This dark line here is the futures market and what they think is going to happen in the future. Okay, let's go back and look intraday. Here on the right-hand side, we gapped lower down to S1. We never did make it down to S2. We kind of danced around S1 for a while, built a bit of a base, shot up to the daily pivot, came back down, and you'll notice I have a moving average on here. I don't use it all that much. Sometimes it's insightful. I don't think it tells all that much, but we came down to this moving average, bounced up off of that, got back up to the daily pivot, and then shot above that, and then closed just about at the high. So it was pretty positive after having a pretty negative open. On our daily chart, we're still in a sideways range right now. On the positive side, we still have this longer-term support below where we're at right now. On the negative side, we have this intermediate-term support, which could provide significant resistance if we start going up. We also have S1 down here, but that would be quite a ways down. And if we get back down into this area, that could really shift the positive things that we're seeing right now. Looking at the bottom, we did see an increase in volume on Tuesday, but it's still below average overall. People are just really not sure what to do right now. We're down 13.26 from the all-time high. This is still the same in spite of everything that's been going on. Those things that are positive remain positive. Those things that are negative remain negative overall. They bounce and go up and down a little bit, but overall, they just continue to be negative. Looking at our trend, this has changed. The ADX has dropped below 20. We're now at 18.04. The green line had been crossing over positive, and the red lines kind of danced in there. It's really hard to tell. it looked to me when I first looked at this chart that it was looking more positive. It's actually looking a little more negative right now, with the red line turning up slightly as the green line's going down. But this is kind of a jumbled mess right now as far as, are we in a trend and is it positive or negative? We're not necessarily in a trend because we're below 20 and declining, but whether we're positive or negative, that's, at least on this chart, I guess I was incorrect when I looked at that. Our rune just shows a decrease in selling and a decrease in buying. We are climbing a little bit, but we're still below zero. Looking at breadth, we're still seeing an advance based on price after seeing this bullish divergence. And we saw a bit of an advance based on volume. So this is looking more positive overall based on price, but we have a long way to go based on volume. The advanced decline ratio is still positive and above zero and advanced on Tuesday. New highs, new lows continue to trend higher with our 5-period moving average, and our 10-period is still going up. Accumulation distribution is above the moving average, and the moving average is going up. And you're probably hearing some drilling in the background, and I apologize for that. This next chart just shows the S&P on the top and the percentage of those that are above their 50-period moving average. And we look at a lot of these every day. I just wanted to show this where it's really been coming down, and we made what could be considered a double bottom, and that matched with price. We had a low here, and then a lower low here, and a lower low here, but it was a little bit offset by that. And then we've been coming back up ever since then, so we are showing some improvement on the 50-period. Now, to me, that's the intermediate term. Let's go and look at some short-term charts. We're still above the 20-period moving averages. This is a new one. This is a triple exponential moving average and a double exponential moving average of a 20-period moving average. And these are designed to move faster. And it just shows the blue line is below the green line, which shows that we're going up overall. This red line here is an anchored moving average, which I anchored it back to the March 23, 2020 low. That was the COVID low. And this is acting as support. The rate of change going back 10 periods is coming off an extreme positive reading. We're still up inside the shorter term rainbow. McClellan oscillator turning up and not necessarily extreme positive. Force index also positive. Stochc RSI extreme positive, which is not really a surprise, as is the Williams %R. 20 period showing a nice advance and not necessarily extreme. The 50 and 200 continue to advance, pegged positive. Intermediate term, pegged positive, and showing improvement in the longer term stochastics. Intermediate term, here's another chart. The first chart I showed you was based on 20 periods. This is based on 50 periods. The red line is the triple exponential moving average, and the DEMA is the double. And it just shows that we're above both of these moving averages. It's a little hard to see, but I've anchored this all the way back to the March 2020 lows. All of our oscillators continue to be positive. The vortex showing a bit of a decline and drop below 1 with the buying power, a little bit of an advance with the selling pressure. The Swinland trading oscillator is turning back up. The BPI, even with the update, it just ticked down. It's kind of stalled out right here, but it's still above 50, and overall it's still pretty much advancing. The PMO continues to advance as well as based on price and volume. PMOs that are rising, starting to get extreme positive, as are the number of buy signals. And we're still advancing with those that are above zero. Summation based on price and volume continues to advance. The ease of movement actually declined a little bit, but we're still above the dashed line. Volume intensity, because we're seeing below average volume each day, it's just going down. The chicken money flow, trying to give us a little bit more of a positive signal there. The TTM squeeze is showing things are much improving. We've switched over to a lighter blue color. Our different charts, and I don't have all of them. The Heiken Ashi is giving us kind of a doji reading. It's been doing that for a few days now. The Kegi chart is still positive with black lines. Three-line break is also still positive. Our different trading systems, the Elder is neutral with the S&P as well as with the SPY. Our SAR system continues to be positive. The go, no-go continues to be more neutral with lighter purple lines right now. Long term, we're below the 200-day moving average. Longer term moving average study showing some improvement on the 50, 150, and 200. Special K trying to turn up. Here is just a short-term fib level chart going back to the high that we set in March to the low that we set back in May. And it just shows that we have retraced 38.2% and we're currently above that now. The next level of resistance, according to this chart, could be at about the 42.24 level. Here's a longer term fib chart going back to a low set in 2021 that I have shown before. It's also showing that we are right about at resistance, but it looks like we're breaking through that resistance. Looking at the broad market, the diamonds are neutral, as are the Qs. The Vixen continues to decline in the bar chart and in the line chart, so fear is coming down. This is the small cap index. I haven't shown this for a while, but we're keeping an eye on small caps, and they're breaking out. They're actually performing quite well. They're above the moving average. They're above the pivot. So we want to see, can they go up, and then can that help juice up the S&P 500 to go higher? Here's a ratio just showing small caps are breaking out when compared to the S&P 500. We want to see that if we want prices to go up. The mid caps are also breaking above their 50-period moving average. Broad markets, the dollar bounced up a little bit on Monday, but then declined a little bit more on Tuesday, but we're still in an overall uptrend. This is what we're watching for. Have we spiked? Is this area up on here the spike, and are we going to keep coming down from here? Or are we going to be able to bounce back up? Oil, my goodness, up at 119.45, and that's all they want to talk about these days. What was happening at other times when oil really spiked? Well, World War I, that was kind of a big thing. The Israel-Arab War back in the 40s, and there was an oil embargo. Oil spiked then. Oil shock 1, oil shock 2. If you grew up in the 70s like I did, you remember 73 and 79 very well. We had the dot-com bubble. We had the giant financial collapse where things really spiked up. And this is where we're at right now. Isn't that lovely? Looking at the correlation, there's still a strong correlation between the S&P price movement and oil. So if one's going up, the other one's going up, even though it has slacked off over the last few sessions. Gold futures are still above their 200-day moving average. Here's the ETF, also kind of dancing along the 200-period moving average. Here's a longer-term chart with a series of higher lows. Silver really had a strong day on Monday, but then not such a good day on Tuesday, at least on this basis. Even though it was up 0.25%, it's been kind of going sideways after having seen a recent death cross. And here's the longer-term chart showing us a series of lower lows. Here's Bitcoin, just because I wanted to put this on here. We're just dancing a little bit above, a little bit below 30,000. Looking at bonds, we ended up declining based on price. The bond ETF was up 0.33%. Now, these are U.S. bonds here, where this is a world bond index over here. Now, another thing, too, is the 10 to the 5 has gone inverted again. I don't know if this means anything or not. Nobody seems to ever bring it up. I just see it on the charts, and I tell you about it. 30-year, we're getting up to the 3% level. Are we going to break above this with the 30-year yield? This has been pretty significant resistance in the past, but we might be shooting up higher. Or are we going to be able to come back down from there? Yields overall declined on Tuesday, at least with the 30, the 10, and the 5. The 2-year, which is what we're really watching, it continues to go up, and the 3-month was pretty much flat. Our possible positive scenarios, the Copic curve, still working on a valid signal. 2-year spike. What I'm trying to do is take this to kind of a higher level. And we are spiking up here. So even though it looks like a little bit of a spike, we're at the high end of this. What we want to see is this thing really come down and then that lead to a significant move in the overall market. We're just not really seeing that yet. The mass index coming off a recent signal, the Pring bottom fisher, a recent signal, the small cap ratio. See how it's breaking out a little bit? Can that give some power to the S&P 500? Even though staples were up, the S&P was up more, so this continued to decline, 0.42% on a ratio basis. So this is still looking like a viable spike, but we want to see follow through with price, and we're just not seeing that yet. So what's our outlook? The technicals are still holding up overall. Sentiment remains negative. It depends. We've got more neutral on that one chart, more fearful, maybe neutral to fearful right now. The growth and value battle goes back and forth. The economic reports that are coming out on Wednesday are the MBA. We get that every week for mortgage applications, wholesale inventories, and then we get a weekly crude inventories report. I usually don't stick that on here, but with oil being so crazy right now, I'm going to keep an eye on that a little bit more. We've got all the geopolitical events that we've been dealing with, Russia, Ukraine, the supply chain issues, inflation, interest rates, oil, earnings, different Fed speak. It's really looking more and more like they've walked back this idea of interest rates lessening in the fall. Now, maybe the CPI report will help shed some light on that, but that seems to be the running scenario right now. And then the longer term situation in Japan. So our scenarios, we're still down overall with rising interest rates and all the other things that I just mentioned. And also this recent trend of selling into strength. If we see that on an up day, we haven't seen that yet, but that could always happen. And then the rising 2-year yield, that could keep prices down as far as the S&P. Now, yesterday they both went up, but if the 2-year yield really starts to scream upward, that could have an effect on the S&P itself. Technicals are negative, but they're turning a bit more positive now and showing lots of improvement. Up. The technicals are looking better. Sentiment is still a little bit more negative. You've got a lot of people that just don't believe what's happening right now when prices do go up, and that's why we're seeing below average volume. The possible positive scenarios, all the ones that I mentioned, all of these have been triggered, and we're still wondering, have 2-year yields topped? We don't know. Is the Fed going to pivot? It looks like right now, no, they're not. The technicals, there are some pivots, moving averages, fib levels, previous levels that we've hit, either intraday high or lows, that could act as support or resistance. As far as our sideways scenario, the ADX is below 20 and it's still slightly negative with the red line on top, but that could switch over. So our conclusion then is the S&P could be turning positive. How's that for a broken record? So short term, yeah, it's pretty much turning positive right now, but there's a lot of negative also currently, especially with a lot of these moving averages still way above where we're at right now. Intermediate term, it's negative, but possibly looking better. Long term, we are still negative. So thank you. Have a wonderful Wednesday. I hope my explanation will help you. I'm going to keep trying to look for charts and look for ways to explain that to you that I hope you will end up finding